All right, good morning, everybody. I'm here with Brad, our account executive, and today we're talking about business purpose loans as low as a 575 FICO. So Brad, what is the difference between like a business purpose loan and just like any other like a residential purchase, bank statement, what, why do we call it like a business purpose loan?
So a business purpose loan is a loan for a business purpose investment property transaction.
Okay.
And in the world of mortgages, you have a couple of different occupancy types. You have your primary residences, which you're in most of the time. You have second homes, which essentially you and your family are occupying that property. It's just maybe a vacation home, or a home that you don't really live in that much, but you have it. And then you have this other classification, and this is what people who have a lot of rental properties. This is
Mm,
that type of occupation classification, and that's the business purpose or
okay.
investor occupation, non-owner occupied. So uh, the benefit or the process for buying an investment property is typically a little bit different than if you were just buying your own primary residence. A lot of lenders out there, if you're going to go conventional, they'll still look at tax returns. They'll still look at they'll make sure that your debt to income ratio is intact, and debt to income just is what are your current debts divided by what are your current income, and
Yeah,
we come up with a ratio. And
yeah,
usually on conventional, that ratio is 43%. Correct, Jacob?
yeah, yeah.
um, with these investor, non-owner occupied business purpose loans, we take the focus completely off the borrower's job information, and the borrower's income information, and we focus pretty much on the cash flow ability of the property, and
Okay.
that's how we qualify that purchase or that refi. Um, in the
Okay, so we don't care about income. We just care about the cash flow from the property.
Correct, right?
Yeah.
Yeah, and there's there could be a couple of compensating factors there, um, but it's mainly just the ability of that particular property to cash flow. And when I say cash flow, I mean, does your payment, your interest, your taxes, your
Insurance.
association dues, your insurance,
Hmm.
that combination of, and that's usually what your mortgage payment is consisting of, is
Hmm.
they call it PITIA, or the payment, insurance, taxes, insurance,
Yeah.
association dues if you have association dues, and then we divide it by the potential rental estimate, or if you already have a investment property and you have a tenant in place, what does that lease agreement with you and the tenant look like? So we divide that proposed PITIA divided by your, um, uh, or I'm
Yeah, the
sorry,
income. Yeah.
your, yeah, sorry. My mind's a little blank today. I think I need more coffee. So yeah, the rental estimate or
Yeah.
that lease agreement divided by the proposed PITIA, and then you get a ratio. And if you're as long as your ratio is 1.0 or above, meaning
Break
the
even.
payment is equal to what you're receiving from the tenant, or what the potential lease could be, then your cash flow is, you're able to qualify essentially based off of that. Now your FICO does play into it a little bit for the rate.
Mm.
And we allow somebody with as little as a 575 FICO to go ahead and purchase these investment properties,
Wow.
because, like I said before, you're really more focused on the ability of the property to cash flow. Um,
So let's. let's dig into the 575 FICO a little. So are there any like let's say you have 575 FICO. A lot of times you have 575 FICO because you have lates, collections, and a lot of times those could be recent. Like, how
Right.
does that affect it? Like, do you have to have like a 12-month history of no late payments or 24-month history of no late payments
So
or yeah,
so typically we are going to look at the last 12 months pretty
yeah,
heavily,
yeah.
and as long as you don't have any bankruptcies less than 12 months or foreclosures or short sales. Actually, the short sale, I'm sorry. You can't have a short sale. You could have a deed in lieu,
Mm,
which the deed in lieus aren't necessarily as common as they used to be. But the short sales are, with the way the market could be turning, we
hmm
might see a lot of short sales kind of pop up, especially if borrowers purchased properties at the levels they are at right now, and maybe they lose their job, unfortunately, or something like that. So we do
Okay.
allow short sales. We don't allow 90-day lates. That's one of the other things that we don't allow, because then you're treading into the foreclosure water at that point. Um,
Okay.
you know what I'm saying? So
Yeah.
as long as you have zero 90-day lates, usually you're going to be in that 575 bucket, because technically we put you in credit buckets, and the
hmm
FICO is the primary factor for the FICO bucket, but it's also any 30-day lates, any 60-day lates, that type of thing, and then we knock you back into a more penalized bucket, so to speak. So if you're somebody who has technically a 650 FICO, but you have a 60-day mortgage late, then we're going to actually drop you back to as if you were to have a 575 FICO. Does that make sense?
Yes. Yeah.
And then, the credit buckets, that's really going to determine what your down payment is going to be, or the loan to value in mortgage broker speak. So if you have somebody that has a 575 FICO, unfortunately, you're going to have to bring about 30% to the table on a purchase. Or if you're doing a refi, you're going to have at least 35% equity built up in your house to even break even on that.
Yeah.
And, probably more like 50% or more on your um, equity for that to even work out, really. Because
Yeah.
you also have to factor in the title closing costs for title work, and Jacob, you don't work for free, so you get a little slice of that pie. And then also, if there's going to be any cash out on that refi, we do allow cash out refis, but if there's any mortgage left on the house, or liens or anything like that, maybe if you have credit cards and something, student loans and collection, you'll have to pay those types of things off with the cash out proceeds. So
So let's go back to the like the cash flow from the rent. So you can buy properties with the intent of Airbnb in them, or you are
correct.
using VRBO or Airbnb. Now, how do you predict rent for Airbnb or VRBO?
So it all boils down to the appraisal,
hmm
if it's a purchase,
hmm
and then if it's a refi, we want to see some sort of ledger. So if you're somebody who has a few Airbnbs or VRBOs, typically you're gonna have your ledger of all of the rents received, or all of the nights that somebody has purchased. Airbnb and VRBO will allow you to download a ledger for all
Nice.
those night stays. So we want to see a 12-month history typically of your ledgers, or we're going to look at the Airbnb, or I'm sorry, the 1007 appraisal, which will give you what an Airbnb should be making per month in your area.
Are okay, so are appraisers doing that now? Are they looking at rent rolls from Airbnbs?
So if it's a refi or if it's a purchase, you want to actually, whenever you're ordering the appraisal, you want to make sure that the intent is for short-term or Airbnb rentals, and
Yeah.
then the appraisal will take that into consideration instead of going off the long-term leases in the area. So a
Okay.
lot of times, you're going to see long-term estimates
Yeah.
whenever you get an appraisal done.
Hmm.
What I've been able to successfully do to help borrowers capture more income on the appraisal is to have the appraiser review the rental ledger. So if
Hmm.
you have if you have a if you're doing a refi, you want to download that ledger. You want to send that to the appraiser. That way they can review it, and then they'll factor that in, and then they'll start looking at short-term comps and factor that into their estimate. If it's a purchase, the only way to really argue, or the only way for the appraiser to take into consideration it's a short term instead of long term, is that if it's in a short term community.
Hmm.
So when I say that, there's a lot of short term communities here in Florida, especially in Orlando, in Miami, here in Tampa. I'm in Tampa and Clearwater. We see a lot of short term rentals, all along the beach. And if you can tell the appraiser, hey, this is going to be used for short term VRBO, um, as long as that is the best use for that property, if it's a short term and that's the best use, then the appraiser has to review all the other short term rentals in that area per USPAP guidelines. So they
Okay.
have to take into consideration the best use.
Got it. Got it.
So, and I can
Okay.
send you a little snip from the USPAP guidelines that they have to abide by law. And you can just send that snip right to them, and the link to the place in the guidelines,
Yeah.
and then they'll have to go off of that. Sometimes
Okay.
they'll give you a little pushback, but if you send them that, they have to by law abide by that.
Nice.
So, yep,
Nice. Good. Okay, so just kind of like to recap. So the business purpose loan, this is for investors that want to invest in either long-term or short-term rentals, such as like
correct.
Airbnbs. You can use it for 1 to 4 unit properties. Your credit score can be as low as 575, and obviously that's going to require a higher down payment. But I mean, at 575, it's hard to get a loan with under 600 credit score, and for investment properties,
Just in
it's hard.
general.
Yeah, it's hard even if you're under 650 or 660. I have clients
Yeah,
that have like,
660 is usually the sweet spot I've seen.
yeah,
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 so we're pretty amenable to anybody with less than a 650.
yeah,
You're just going to have to pay a little bit more
right,
for the down payment, and the rate's going to be a little bit higher.
yeah.
Um, but
But the
you
alternative
can
is
always
paying,
work
yeah, all cash for an investment property.
exactly, or
So
you can always just work on your credit, which I mean you should be doing that anyway. Um, you know, if you're buying an investment property, you should also be working on paying off your current debt, right?
yeah,
So borrowers can always work on their credit and then refi out of the loan after 5 years.
right.
So the other thing that I want to kind of leave us with is that not only is it for 1 to 4 units, you can actually go up to 29 units on these business purpose loans.
Okay.
The fix and flip also plays into that, which we've already talked about. That's technically a business purpose loan.
Mm.
And foreign national and ITIN borrowers can also participate in
Oh,
business
nice,
purpose loans.
nice.
So they don't have to be U.S. citizens. They can have a green card. They can be an ITIN borrower. They can be essentially undocumented.
Right.
And then any foreign nationals, they don't have to have U.S. based credit. We won't look at any job again, no income, no foreign tax returns. A lot of other lenders, they'll on foreign nationals anyway, they'll make you do like an international credit report,
Yeah.
or they'll make you do like a profit and loss statement from the foreign business and look at
Hmm.
foreign tax returns. We
Yeah.
don't do any of that nonsense. We literally just look at a passport, no visa, has to be a passport, and 2 months worth of their bank statements to make sure that they're in good standing with their current financial institution. And that's what we do to qualify foreign national investors. So
Okay.
they have to
And
have
then
30% down on a purchase,
right.
35% on a refi. But that's what you're going to pay as a foreign national anyway,
Yeah.
regardless of where you go. So you might as well take the easy way out and just give us a passport, 2 months worth of bank statements, and not have to deal with all the other stuff that maybe you might get a quarter of a percent better rate, or maybe even
Right.
3/8, maybe even a half. Who knows? But you're going to have to go through a lot more rigmarole with some of the other lenders, because they're going to be looking at tax returns and FICO stuff like that, foreign credit. So
Right. And then also one thing we didn't touch on is that you can close in a business entity, which a lot of times when you're buying a property, if you're using Fannie Mae, Freddie Mac, you have to take you can't buy it in a business entity. You have to buy it in your name, and then afterwards you can
then
put the title in a
quit
business
claim it
entity.
or something,
Yeah,
right?
yeah.
Yeah,
So with this, you can buy it in your LLC, your S corp, or whatever business entity you have established, if that's what you want to do.
yeah. And the caveat to that is it does have to be essentially like a shell LLC or a corporation. It can't be like Jacob's Laundromat LLC, where you
Oh,
own a laundromat
okay. So it
and
can't
you're
be
trying.
operating. Yeah, it
Yeah,
can't be
yeah,
operational. Okay, I see. So you would
exactly. Yeah, it
just
has.
you just
But
establish
you
it in
just
name
yeah,
only.
you just establish an LLC
Okay,
and
gotcha.
put the
Okay.
property under there. So
Okay.
and then
Okay.
anybody with 20% or more ownership of that LLC also has to be on the loan. So
Yeah.
keep that in mind.
Okay.
Yep.
Nice. Okay, well, I think this wraps it up. I mean, if anybody has any questions, reach out. Let's see,
Reach out to Jacob.
tomorrow we're going to be talking about, let me see here. I think it was the condo tales,
Okay.
actually. Yes, condo tales. So that should be cool. Looking forward to that. All right,
There's a lot of those
Brad.
out there.
Yeah, yeah, absolutely. Well, thank you so much, Brad. Good information, and it's gonna provide some more options. So good stuff.
Pleasure,
All right,
pleasure, and thanks again, Jacob. I appreciate you having me on.
no problem.